Warning. This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Right, hello and welcome to Camel Finance. I'm your boy Camel and this is your weekend's deep dive and all of that good stuff. I want to talk about the idea of mine, this melt-up idea, which is a blow-off top culminating in a global recession and a deflationary bust. I want to ask myself the question, is it still valid? Are we still in play? Are we still on track to see that play out? And I also want to talk about the exponential age idea, which is that everything is going to continue to go up for a very long time because everything going up is really just a function of fiat currency debasement. And since they are going to continue to debase the currency, then we should see everything continue to rise indefinitely as the currency is debased against assets. So I want to talk a little bit about both of these ideas. I know a lot of people seem to mostly agree with this idea in that we have indeed just been in up-only mode for well over a year now. But the part of this idea that most people seem to get hung up on is that global deflationary bust, that global recession, and a lot of people seem to be leaning more towards this whole exponential age idea in that we have many, many years of upside left ahead of us. Now, to be clear, as always, I'm open to both. I'm open to being proven wrong by the market, and that is why I am open to being invalidated. So I also want to discuss where exactly I would consider myself invalidated, where I would be willing to pivot from a deflationary bust to an exponential age idea. For the interest of full transparency, it's also important to point out that the doom and gloomers and the bears, that is not a non-zero probability that they could be correct, right? We could indeed be about to enter a straight down mode for a while, or indeed sideways. It's a market, anything can happen. But for me personally, that's the least probable outcome. And you can say this with confidence because the markets just continue to make higher highs and higher lows. So until such time as that changes, until we start to go sideways or start to see technical breakdowns, then the doom and gloom bears just seem to be completely wrong-footed to me. So far, this is definitely in play, and so is the exponential age idea. Both of these are in play at the moment. So like I said, we're going to talk about that and where exactly we'd be invalidated on the melt-up idea and start to switch to accepting a more up-only for many years to come as a function of currency debasement. So this week we had more jobs data come out, and the jobs data was actually not bad, right? Actually not bad at all. That is, of course, if you believe the current data. Mainstream were quick to hop onto this and say the labour market surprised economists with its strength once again. Now, it's important to point out, something like out of the last 11 jobs reports, 8 or 9 of them have been revised a couple of weeks later. So it's a wild time to be alive. We can't really trust any of the data that comes out anymore, which makes being a macro guy incredibly difficult. And that's also one of the reasons that the longer I am in this game, the more I am shifting away from macro, the more I'm shifting towards being a technical analyst only. But if you take the data at face value, okay, the economy is not yet in a recession and the labour market is actually resilient and stronger than most people were anticipating. I've been talking about U3 recently because I believe it is a much more representative data set. March's print came in at a 3.8. And the reason this is so significant is because using U3, okay, which is the 3-month moving average of the national unemployment rate, when we see that rise by 0.50 percentage points or more relative to its low during the previous 12 months, we trigger something known as the SAM rule, the SAM recession indicator. So according to the current data set, we are just about swerving a SAM recession indicator triggering. But we are indeed getting dangerously close to seeing this recession indicator trigger. And as always with the macro, it really depends on which way you look at it, right? The full-time employment growth has actually gone negative. Now, the grey areas are recessions, and what you'll notice is, in most of the grey areas, we see a sharp decline, a rollover. Particularly, we see this into the negative section, into the negative territory below the zero line, and that is what we have at the hard right edge. So this, again, says to me that we can't rule out the possibility of seeing a recession. And the real unemployment rate is much higher than the 3.8% that they report for U3. Because if you account for the millions of people missing from the labour market today, the unemployment rate isn't 3.8%, it's between 6.5% and 7.7%, depending on which data set you prefer to use. Now, this, of course, is synonymous with recessions. And again, they can keep fudging the data, but to me, that just makes me even more convinced that we are indeed going to see a recession in the not too distant future. Because, in my mind, why would they continue to fudge the data if everything was okay under the hood, right? Why would they keep changing the way they calculate CPI? Why would they keep revising data down 2 weeks later quietly after they release a seemingly strong employment data set? All of this to me is quite spurious, and I know it is to many of you as well. Not to mention, the Fed says things like it expects to be in a position to cut rates later this year, and then it comes out and says the Fed probably isn't going to cut this year because inflation is going to continue to stall. Then they'll come out and say, whilst it's not likely, it's entirely possible we might have to hike again in order to cool inflation. So again, fitting in with this theme of how do you be a macro guy, all of the data is fudged and fake, the Fed speakers, in summary, come out and say we could do 3 rate cuts this year, 2, 1 rate cut, or no rate cuts at all, or even a hike. So aren't you glad that they're giving 20 speeches a week to clear everything up, right? This is the world we live in. It's an absolutely wild time to be alive. Inflation, if you use trueflation, and again, this was working very, very well up until they changed the calculations a couple of months ago, and then it suddenly stopped providing an edge over the markets. But currently, if you believe the trueflation metric, which I actually believe is closer to reality than the official government reported rate, we are below 2. So inflation, in theory, is under control. And you can see by this overall downtrend, it's also declining. To be clear, that doesn't mean that we couldn't be sticky here. That doesn't mean we couldn't see a spike. But it does mean we haven't seen either of those things yet. And despite all of the Fed talk that we keep seeing, despite them saying everything under the sun, like I said, cuts, no cuts, hikes, the CME is usually very, very reliable for letting us know when we're going to see the first cuts, so long as we have an 85% probability or higher leaning in one direction. Now, using this idea, we can see that cuts are pretty much off the table with near certainty, as much certainty as you can have in markets for May's meeting. Clicking out to June though, we are now starting to see them slowly but surely take rate cuts off of the meeting in June. Just since Friday's session, we have changed from a 34% probability that we would be remaining paused to a 47% nearly probability that we are not going to see any cuts in June. So again, they are slowly but surely taking the cuts off of the table for June and pushing them back yet again to perhaps July, which currently sits at around a 2/3 split, 2/3 in favour of seeing cuts as early as July, with just the remaining third suggesting we will remain paused. Again, on Friday, there was only around a 20% probability that we were getting out of July's meeting without seeing a rate cut, and now we sit much closer to 30%. So the Fed is continuing to kick the can, right? It's continuing to push these rate cuts out further and further, and of course, the reason this is so significant is because the market tends to rally. The market tends to rally up until the point where they start cutting rates, and then assuming they're not cutting into normalization, assuming they're cutting because they need to cut, or because something is broken, or because a recession is triggered, or because they are forced to start to try to be more accommodative to markets, typically what we see is the stock market put in a top within 0 and 2 months of the onset of that cutting cycle. What this tells us is the further they continue to push these rate cuts back, the more gas there should be left in this goose, right? The more space we should have to run higher. And again, making the data set even more complicated, you can see here the US CPI is in the bar charts, right? And the orange line is the TMC Global Credit Impulse, which typically leads CPI by 18 months. Now, what you'll notice, again, is this thing is slipping into deflation. Okay, so all amongst the narrative of higher rates for longer, of sticky inflation, and all against a backdrop of them continuously telling us the labour market is strong, when actually when you look into the data under the hood, the labour market and unemployment rate is really something to be more concerned about than they are letting on. We're still expecting to see CPI continue to fall. Now again, do we actually see that manifest in the real world? Because like I said, they keep changing the calculations, they keep fudging the data. But if this TMC Global Credit Impulse is anything to go by, then we should still be expecting to see a drop into deflation. I know that's not a popular argument, but the data is the data. Don't shoot the messenger, I'm just presenting it. And so everything I've presented so far is the base case. That has been the base case for this melt up, blow off top idea, followed by a deflationary bust. You can see this was proposed a long time ago. And checking in on today, we can see that we're more or less in the timing window to see the final thrust, the final blow off top portion of this rally. And then if this is going to continue to be the base case, it tells me to expect some kind of blow off top a breakdown, a rollover, and then we'll finally see that deflation. As you know, if you've been here before, we've got the Dixie expected to run to 140-ish. Of course, that would be characteristic of deflation. All of this, of course, would be asset deflationary as the stock market tanks. And I have been speculating that we will see this as part of a global recession. And like I said, the unemployment data is starting to look more and more like we are indeed going to get that global recession. Now, it begs the question, can they continue to just goose this thing? Can they continue to grease all of the numbers? Can they continue to just prop this thing up because it's an election year? And that, of course, is to be determined. But so far, when you zoom out here, it's hard to make the argument, unless something changes very quickly, that we aren't setting steeper and steeper angles here. We have undeniably set our first angle here in blue. We also are in the process of either setting our second angle, or perhaps we have a slight decline into a weekly cycle low. We'll get to that later. First, to end up setting an angle more here. And then, of course, the third angle is going to come not too far in the future. Now, you tell me, if we set that third and final angle, if we end up with a shape like this, does this resolve A, to the downside in quite a nasty manner, or B, do we continue to just move higher into the exponential age? Is it entirely possible that we're going to do something like this? And this is the reason I don't like the idea that we are just going to continue to see fiat currency debasement drive everything higher. I do believe we see fiat currency debasement for sure. That seems to be mathematically guaranteed given the amount of debt. There's no other way to service the debt. But all the while we continue to set this parabola, these three angles of increasing steepness, and all the while we're doing so against a backdrop of a deteriorating economy that they continue to lie to us about. Okay, this at the hard right edge is not nothing. This is not nothing. Now, of course, it doesn't preclude us inverting, but it also is quite likely, in my humble opinion, to get a lot worse before it gets better. If this continues to get worse, it certainly tells me at least to keep an open mind about seeing a recession, seeing something break. And if, of course, all of that shows up, if we start to see things break as we're at the top of a parabola with the backdrop of them cutting rates sometime in the middle of the year, depending on how far they continue to push these rate cuts back, it tells me at least to keep an open mind that this is not yet invalidated. So for me, invalidation would be breaking down here, trading sideways, moving lower in the short term. Invalidation would be not setting a third and final angle, something like this, okay? That would also be considered by me to be invalidation, having some big correction similar to what we had here, and then a resumption more like this. All the while we continue to set a blow off top. All the while this continues to be more or less correct, this arbitrary yellow squiggle of mine. And all the while it's against a backdrop of a deteriorating economy and a deteriorating labour market that they continue to lie to us about, potentially even with the idea that we're going to slip into negative CPI in the not too distant future. I am forced to continue to accept this as the base case hypothesis. Now, don't get me wrong. If somehow we're not going to enter a recession, we're not going to slip into deflation, if CPI is going to start to spike and climb, if they're going to start to print infinite amounts of money, and the stock market does not show any form of breakdowns, if we do not get any kind of trendline violations, if we do not get any kind of failed cycles and rollovers, then for me, I will continue to remain long. I will continue to remain long until we get these breakdowns. I'm not just going to flip bearish for no reason. I will, of course, be open to this exponential age idea. But when I zoom out and look at the chart, it becomes increasingly difficult for me to imagine that this is going to continue for many, many years to come. I also think the writing has been on the wall for Bitcoin. This all seems to be feeding into this idea that we are getting quite late in this cycle, that we are approaching this deflationary bust, that we are going to see a global recession take hold in the not too distant future, because this Bitcoin idea of mine, which granted is a little bit behind schedule, we are currently somewhere in here in terms of time and price, slightly lower for price. We're somewhere in this neighborhood, right? So it's done more or less this. But to me, the fact that Bitcoin managed to break its all-time high before its halving, the fact that it is setting itself up to currently have price discovery, right? We are right around the all-time high. We are getting ready to enter that final leg higher into what I have been calling or suggesting would be a left translated cycle top. And if indeed we do get a trendline violation like this fractal suggests, if we do start to break down here, then again, all of this idea fits with the fact that something will have broken under the hood. As always, I know my invalidation. If we, from here, continue to trade sideways for a while, for multiple months, and then start to emerge, then we can scratch off the idea of a left-translated cycle. If we do not end up setting the third angle, which is more steep in red as this suggests, if we come down to this second angle and hold this for a while, then it still allows us the time and the space to see that third and final angle come in much later in the year, or perhaps even later of next year. But again, it is hard for me to say this thing has been invalidated when so far it is playing out more or less to be expected. The timing of all of this is spurious, as I've been saying, and so is all the data underneath. I can say with higher confidence now than I had when I was posting this or this, right? I can say with a much higher degree of confidence now that these ideas are coming to fruition. they seem more and more likely now than ever before. I am, of course, always open to every outcome. I'm always open to letting the market prove me wrong. But until we start to see technical breakdowns, until we start to see invalidation on this idea, and until we somehow start to see improvement in the employment rate, until this thing starts to reverse, until CPI starts to prove itself that it's sticky or even start to increase, then I am forced to continue to accept this idea and continue to adopt this stance that it is right until it is proven wrong. I think it's important to point out here, if we do indeed enter the exponential age, if this is going to be the trend forever and ever and ever, then of course that will be fairly easy to deal with. We'll be able to draw some trend lines underneath and stay on the right side until they eventually break down. Maybe they don't cut here in the middle of the year or late summer. Perhaps they end up cutting way later in life. Perhaps they end up hiking and then cutting eventually. Overall, the exit strategy will be the same. Technical breakdowns will be technical breakdowns. The onset of a cut-in cycle will most likely be due to the fact something has broken. And we should do just fine at riding whatever trend presents itself. But to me, this whole thing seems kind of preposterous. It seems crazy to me that we are just going to continue to do this for a very long time. I see an awful lot of people saying things like it is impossible to have a recession in an election year. And to that I simply say, well, 2008 was an election year. So as ever, one day at a time, see what the market can give, open to all outcomes, open to being proven wrong as always. Bitcoin continues to do Bitcoin things until, of course, it doesn't. And like I said, if it starts to deviate away from this, then we can start to build a plan B. But for now, all the while we're holding this, all the while we are roughly trending up towards an early left translated cycle top, then I continue to accept this as the base case hypothesis. It's also important to point out for Bitcoin that our initial rejection and perp premium is back. However, a couple of things to note this time around is this little move is completely flushed all of the open interest build-up that we got on the rise so far, which is healthy, and we still have a lot of bids stacked below the price right now on Binance perps. Cred was looking to short and hedge into this zone, but he's now going to sit on his hands as he thinks there's a decent chance that we could be about to begin the move up to new highs, and we may not get the pullback that he was anticipating. To zoom in on this current price action, we are potentially about to finish completing this triangle pattern, and that would mean that what comes next are much higher Bitcoin prices. And you can see here, one of my suggestions for Bitcoin was that we would perhaps have to entertain a 2-month or 60-day consolidation cycle before we could emerge. However, I've been very clear in saying that, if I move this out of the way so we can see, if we do indeed start to push off from here and get a breakout of this downward sloping blue resistance line, then it could be party time a lot sooner, right? We can't rule this out as a move. And if that happens, then all we would have done is found a cycle low, made a higher low, and then broken out doing standard 60-day cycle things. So all the while we're range bound, it tells me to keep an open mind about seeing this consolidation cycle. But if we do start to run the highs, if we start to break out, then again, it feeds into that idea of this blow off top, this early left translated cycle. And then from there, we obviously have the two scenarios, which is one, that we go extended bear market, or two, that we get some kind of double pump. And again, we will deal with that in real time as it arrives and as it presents itself. For now, though, hard to be bearish all the while we are holding above the cycle low for Bitcoin. I've been talking about the stock market being overdue for this daily and weekly cycle low. Is this the top? Have we just seen the top come in? Are we going to do something like this, trend down into that daily cycle low, and then start firing off? As I've been saying over and over again, by zooming out, if this is to play out, we would have our second angle, and then we would be looking for that third near vertical angle into the blow off top moment. So I've been tracking this thing the whole time in real time since the lows. The channel OGs and the people that tune in every day have known and seen this. Again, it's really difficult for me to get away from this idea all the while it continues to play out roughly as expected. As I said in yesterday's video, we're also going to be looking for a subtle hint from the market just to find out exactly how berserk and how bananas the current strength is. If indeed next week we get an immediate breakout and a push higher to new highs before then a shallow daily cycle low, that would be indicative that we are even later in this blow off top idea, because it would mean the second angle of attack has likely already been set, and thus we would be expecting the third and final near vertical attack just days to weeks away. So either way, we are going to learn something. Either way, there is going to be a cycle low show up somewhere around the 19th, and that is going to be my opportunity to add my exposure back in the S&P and the NASDAQ. Still pushing the Dow, although as you'll notice, didn't really do a great job at recovering from the trendline breakdown. The stop is choked up as indicated by the dash line. And like I said, we'll keep pushing this. Normally, when we get a strong trendline breakdown like this, I would have cut the trade somewhere around this level here. But given how bananas the stock market has been, given the amount of dip buying and the extraordinary underlying strength that we have seen, I've decided to let the stop do the worrying, give this a little bit of space just in case it does decide to reverse strongly up here. Either way, we're walking away with a good 4,000 odd points. And the Russell 2K still hanging on to its upper sloping red support line, still above the range break in the blue box. So happy days, long and strong, continue to push, expecting higher prices there as well. Gold is doing gold things, isn't it? So gold continues to push. There is a daily cycle low due somewhere around the 18th of April. For me, that dip is for buying, that dip is for moving stops up, that dip is for increasing exposure, ready for the next leg and the next daily cycle. Silver is also starting to believe that this rally is for real, and we're seeing that now. As I often say, gold needs to give silver permission to move, but apparently that is exactly what is happening. $30 for silver should probably come in quick fashion. And all of this, of course, against the backdrop of the dollar index thinking about breaking down. Now, we can confirm this as a real legitimate breakout if we break above the local high cluster set back on Monday. But all the while we are under that high, all the while we are thinking about challenging the upper slope and blue support line and potentially breaking down, then we may have to be putting our focus on having not yet seen a 3-year cycle low. And of course, any rollover here from the Dixie would indeed fuel that melt up. It would indeed fuel the blow off top and would likely see Bitcoin and risk rally very, very strongly. Of course, the more vertical we go, it's also worth pointing this out, right? No matter what happens, whether we get a pullback and a nice sharp V, it could come all the way back down to this 4,800 level for the SPY, right? We could come all the way back down here and then V out of here, and it wouldn't change much in terms of a blow off top. We would have a second angle set somewhere like this, and we would expect that third angle to be coming in the not too distant future. I ask you a serious question if you're one of these melt up doubters, right? If indeed we do put in this blow off top, by the time the price has done something like this, okay, what do you think happens from there? Zooming out and looking at this, what do you actually think happens from here? Do you think this continues, or do you think we have to start to entertain the second portion of that melt up chart coming into fruition, like I said, over and over and over again, all against a backdrop of weird, spurious data, of concerning employment numbers, and perhaps not the sticky inflation that the market is calling for? I hope I've given you something to consider. If you're a level 3 member, look out for the deep dive on the crypto stocks and all of the other metals positions we've got going on. That is going to be coming out just after I upload this video. Oh, and I almost forgot. Head over to Creative Precious Metals channel, hit subscribe for 2 reasons. One, I'm going to be appearing on Creative Precious Metals channel tomorrow at around 2 p.m. GMT. So go and watch a long format conversation. We're going to be drinking some rum, drinking some whiskey, having a chat with a couple other guys, which I'm really looking forward to. Make sure you get him to 500 subscribers because he has a very generous Bitcoin giveaway. I think it currently sits at around 250 quid's worth of Bitcoin. So 1 in 500 probability, not too bad. So go and show him some love, subscribe to that channel and tune into his videos so that you can be ready to win the 250 quid's worth of Bitcoin. Of course, I'll throw this out there just because it is what it is. If you receive this not in a hot wallet, if you receive this in a new, fresh, cold wallet, it would be a nice opportunity for you to easily acquire some non-KYC Bitcoin. I'll leave it at that. I'm your boy Camel. Consider becoming a member because we are conquering the metals markets and the crypto-related stocks. Have a fantastic weekend and catch me on CPM's channel tomorrow at 2 o'clock. Until then, have a great weekend. All the best. Cheers. Bye.